Most financial advisors charge about 1% of your assets per year. The number sounds tiny. We're going to walk through the actual dollar math and the specific point in your life where 1% goes from a waste of money to one of the highest leverage purchases you'll ever make. We'll cover three things. One, what 1% actually costs in dollars across different account sizes. Two, the four specific situations where most households genuinely don't need an advisor, and you can run the basics yourself with a couple of free tools. Three, the four situations where 1% is roughly the cheapest professional service you'll ever buy. There's a single financial event at the end that flips the equation harder than any net worth threshold. Stick around for that. Let's anchor the numbers. The standard fee structure is what's called assets under management, AUM, and the typical rate is about 1% per year. Some advisors are 0.5%, some are 1.25% sliding by account size. We'll use 1% flat for the math. On a $50,000 portfolio, 1% is $500 a year. On $250,000, it's $2,500. On $1 million, it's $10,000. Here's the part most people miss. Imagine your portfolio as a bathtub slowly filling with returns. The fee is a small drain at the bottom. Each year, a little flows out. Doesn't seem like much. Over 30 years, that drain takes somewhere between 15 and 25% of total ending value, depending on the return assumptions you use. That's the cost. It's real. The question isn't whether 1% is expensive. The question is whether the advisor produces value greater than 1%. Sometimes yes, sometimes very no. It depends on your situation, not your net worth alone. Four situations where a 1% advisor is probably costing you more than they're producing. One, your situation is genuinely simple. W-2 income, employer 401k that you max into a target date fund, Roth IRA on the side, no business, no rental property, no inherited wealth, no equity comp. If that's you, the cost benefit isn't there. A target date fund and an automatic Roth contribution captures most of what an advisor would set up for free. Two, you're under about $200,000 in total invested assets, and your savings rate is the lever that matters more than your investment selection. At small balances, the difference between a good advisor and a free target date fund is a few $100s a year. Behavior change of saving an extra 5% of income produces 10 times more wealth than any portfolio tweak. The fee buys you something that's not your bottleneck yet. Three, you have the time and personality to do it yourself, and you actually do it. Knowing what to do is different from doing it. If you've stuck to a written investment plan for at least 3 years through one market drop, congratulations, you're rare. You don't need an advisor for behavioral discipline because you've already proven you have it. Most people who say this don't actually have it. Be honest with yourself. Four, you only need a one-time question answered, not ongoing management. Things like, should I do a Roth conversion this year? How do I structure my emergency fund? For one-off questions, a fee-only advisor on an hourly or flat project basis, not AUM, is the right hire. A few $100s for a focused conversation, not 1% a year forever. Now, the four situations where 1% is one of the best dollars you'll spend. One, your situation has structural complexity. Self-employment income, S-Corp distributions, K-1 partnerships, equity compensation with ISO and RSU layers, multiple rental properties, multi-state income, inherited brokerage accounts with cost basis problems. The tax planning alone routinely saves more than the 1% fee before any investment management even enters the picture. The advisor isn't picking funds. They're navigating tax code that punishes the wrong move. Two, you're approaching retirement with $500,000 or more across multiple account types. A 401k, a traditional IRA, a Roth IRA, maybe a taxable brokerage, and HSA. The withdrawal sequencing problem is non-trivial. Pull from the wrong account in the wrong order, and you can pay tens of thousands more in taxes over a 30-year retirement than you needed to. This is a calculation problem with real money on the line, and most retirees can't reasonably do it themselves. Three, Major life event with financial implications you can't fully see. Divorce, death of a spouse, receiving an inheritance, selling a business, approaching long-term care for a parent. These have one-shot decisions inside them. Beneficiary changes, trust funding, asset titling, tax filings that are very expensive to get wrong and very hard to undo. The fee for 1 year of advisory work during one of these events is almost always worth it. 4. Recent retiree, fear of permanent first 5-year mistakes. The first 5 years of retirement set the trajectory for the next 30. There's a phenomenon called sequence of returns risk, your withdrawal pattern interacting with early retirement portfolio drawdowns. That's mathematically brutal if you don't structure for it. Here's the event I teased at the start. 3 to 5 years before you retire, not at retirement before, is when an advisor's value goes vertical. Not because of investment selection, because of the de-risking corridor. Picture the runway before a plane lands. The plane spent the whole flight at 30,000 feet. Autopilot, smooth. The last 5 minutes of descent are where every wrong adjustment compounds. From about age 60 to 65, or whenever your retirement date sits, you're moving from being a wage earner to being a portfolio retiree. That transition has more discrete decisions than the previous 20 years combined. When to take Social Security, whether to do Roth conversions in the gap years before required minimum distributions kick in, whether to draw from the brokerage first or the IRA first, how to cover health insurance until Medicare, how to position withdrawals for the spouse with the longer life expectancy, whether long-term care insurance still makes sense or whether self-insuring is cleaner. Most are one shot. Once you take Social Security at 62 instead of 67, you can't take it back without a narrow window. Once you blow past the income threshold for the year and miss the Roth conversion opportunity, that year is gone. The 1% fee in this window often saves multiples of itself every year for the rest of your retirement. If you're inside that 3 to 5 year window, or in any of the 4 situations from earlier, the Licensed Advisor Match service is launching this week. Subscribe and hit the bell so you catch it the moment it drops. Subscribe and hit the bell so you catch the next one. New episode every Monday, Wednesday, and Friday. If this one was useful, like and follow Wealth Unlocked. That signal is how the algorithm knows to show this kind of content to people it'd actually help. Quick note. Everything in this video is for educational and entertainment purposes only. Always talk to a licensed professional before making decisions. Always verify any advisor's credentials at brokercheck.finra.org or advisorinfo.sec.gov before engaging. See you in the next one.